Hello and welcome. You're watching Market Edge here on ET Now. I'm Harsh Saita. With me is Meryl D'Souza. Let's quickly take you through what markets have done this week. Essentially, the Nifty has done well. We're up around 0.8% thereabouts. It's not been a tough week at all. And it's been fairly range-bound, frankly, last couple of days at the very least. In terms of how the mid-cap and small-cap indices have done, let's quickly pull those up, give you a sense as to how those have moved. And as you can see, the Nifty mid-cap has done well, 1% higher on the Nifty mid-cap index. The small-cap index also has held up in fine fettle, in fact 3.25% higher on the Nifty small cap index. In terms of the big moves, at least for the week gone by, we've seen some very decent moves among sectors. The PSU banking pack has moved 5.5% this week, 4% higher on defense. Auto has moved 3% this week after the earnings have held up very well. Metals and IT are the other two, which have done very well for themselves, 2.5% to 3% in terms of the moves. In terms of the laggards, it's just been realty, frankly. Not much of a move on the Nifty bank either, just about 1% all through the week. And therefore, there's been a lack of support, especially from the heavyweights, even though Reliance Industries moved quite a bit on Thursday in the day of trade. So we saw a decent move there. In terms of the top gainers for the week on the Nifty, and again, it's not been extremely choppy per se, but we've still seen quite a few movers. Hindalco was the top mover for the week gone by in terms of the positive mover, 8.5% in terms of the move. Grasim, SBI were just some of the others which have done very well for themselves through the week. Shriram Finance was up 6.5% as well, and Eternal moved up a sharp 4%. In fact, Infosys and TCS also moved up 4% each. So you saw some decent moves on the back of the couple of good weeks that Infi and TCS have had already. Bajaj Finance was down 5.5% thanks to the move today, frankly, more than any of the other days where we saw a knock. Power Grid was the other one on the back of numbers. Max Health and HDFC Bank both moving around 2 to 2.5% to be under a bit of pressure through this week. So that's how the weekly trend shaped up. Over to Darshita. She's here with the cues you want to keep on your radar for next week's trade.
Right, coming week is packed with macro triggers, earnings and IPO action. With that, let's take a look at cues to watch. Now back home, the key focus will be on India CPI inflation on August 12 and wholesale price inflation on August 14, while weekly Nifty and Sensex expiry will continue to keep the traders busy. Globally, the biggest event is the US CPI data on August 12, followed by US retail sales, PPI jobless claims and consumer sentiment, all of which could shape the expectations around the Fed's next move. Investors will also watch China's inflation data, UK GDP, Eurozone GDP, along with the IEA and the OPEC monthly oil market reports for the cues on crude. Now, on the earnings front globally, Tencent and Berkshire Hathaway will be in focus. Back home, key results to watch include Apollo Hospitals, Grasim Industries and Tata Motors, while stocks like Bosch, Bharat Forge, Vodafone Idea, Siemens, HAL, IRCTC, Petronet LNG, Page Industries, Max Financial, Jubilant Foodworks, Chola Financial and Ashok Leyland could see some action. Apart from this, the IPO market remains active with Shiprocket, Milky Mist Dairy, Dhoot Transmission and Mobile Diagnostic hitting the primary market, while Fractal Analytics and iFinance will set locket expiries, making them stocks to watch through the week.
That was Darshita with all of the important data points to track in the coming week, but we've also got a list, a lot of major earnings trickling in. Avi is here with that list as well. Avi?
Three major companies are going to come out with their earnings in the next week, so let's have a look at what we are expecting. Let's start with Tata Motors PV coming on the 13th of August. Their India PV business growth has been very good and strong, much ahead of the industry growth at 46% on a yearly basis, aided by the launches of Tata Sierra and the Punch EV doing very well for the company. However, we expect margin contraction by around 2.5 to 3% because of commodity cost inflation. Talking about the JLR segment, we can see that the wholesale sales has declined by around 9% on a YOY basis, because of supply constraint and also a fire incident that broke out at one of the major components suppliers factory. So that is the reason we can see some decline in JLR, but some very good business on the India PV front. Up next is Apollo Hospitals coming on the 12th of August. We expect the hospital EBITDA to increase marginally by around 30 bips because of the losses that are coming in from the new hospitals. The profitability improvement of Healthco and scale up of new hospitals will be something to look out for in the results. We expect the Healthco EBITDA to further strengthen in this quarter gone by. Next is Grasim Industries coming in also on the 12th of August. We expect the VSF revenue to grow by around 14% YOY, while the chemical segment revenue is also expected to grow in the same range of 14%. The VSF EBITDA may grow by around 2.2 times on a YOY basis, and the operating margins to come in at 15%. 15.5% for the VSF. Talking about the chemical segment, we expect the operating margins to dip by around 2.7%, coming in at 15% overall for the chemical segment. So all in all, this is what we are expecting, some very strong results from Tata Motors PV, but margin contraction. Apollo Hospitals coming in out with the strong results, but the losses from new hospitals dragging the margins a bit down, and some strong growth both in the chemical segment and VSF segment from Grasim Industries.
Okay, thank you so much for that, Avi. Let me bring on board Rahul Arora, CEO at Ashika Institutional Equities, joining us this afternoon. Rahul, it's been a while and good having you here. End of the week allows us to zoom out a little bit and understand what trends are playing out. Let's start off with the market, Rahul. How is it that you're looking at the Nifty, the levels, the valuations at this point of time, top down, first off?
Thank you for having me on the show. So I don't think valuations are unreasonable. I think, obviously, this is not going to be a year where you're going to see a 15% earnings growth. I mean, we'd be lucky to probably head into a teens earnings growth. But I think if you look at the upgrades to downgrade cycle, I still don't think it's convincingly in favor of the upgrades. But that being said, my sense is that, over the next 3 months or so, as we hit the US midterm elections, things could be a bit volatile on the geopolitical front. I think as far as India is concerned, we've got crude in a reasonable band. I think compared to, say, where we were 3 months back, and, the prognosis was what if prices around $90 to $100. I think that commentary has changed dramatically. I think with the CPI print that's come in over the last couple of months, there's an expectation that perhaps this will at best be a shallow rate hike cycle, if at all there is one. Consumption seems to be doing pretty well. I think, if you look at most of the consumer staples companies or even the auto companies that you saw in the monthly sales numbers are doing pretty well. Banks are reporting fairly good numbers. So I think there is certainly a case for the markets to probably go up another 5-10%, but I don't think there is enough of a case to make, to say that whether the Nifty can actually decisively break 26,500 and sustain at those levels. So I think at slightly higher levels, you might see some profits coming, being taken off the table. But my sense is overall, if you look at the construct, we're still not too bad. I think we'll probably grow at somewhere between 6.5 to 6.8% this year. I think most people have accepted the fact that the rupee will probably be in a 94, 96 band, and the 10-year bond yield probably around 6.75 and thereabouts. So I think if you stack all of that, in the backdrop of the earnings season that we've seen so far, I think it's a fairly valued market, and the risks to the upside could be another 5-10% on the index. But I think prima facie to make a more bullish stance than that would be a little, I would be a little circumspect doing that.
Okay. Rahul Medal here also joining in. You said that it looks like quite a fairly valued market, but the FII flows seem to point towards otherwise. I mean, they were buying in the last week and now they've turned net sellers. What's your outlook on that? What could lead to FIIs to then, strongly come back to India?
I think the FII selling accentuated around the time, the war started. And it married itself into the narrative that India was not really a hub for artificial intelligence. So I think if you look at let's take the largest sector in India, which is banking. If you look at the credit growth of the scheduled commercial banks, which is the non-food credit growth over the last 3 months, it's been hovering in the range of 15 to 18%. So they've not been doing too badly. And had the war not happened, and you had not gotten into a crisis situation on the rupee, you would probably be in a situation where you would talk about NIM expansions and things like that. You would not be discussing asset quality as much as we are right now. Now, in that backdrop where banking seemed to be doing okay, it's still derated. And the reason for that is I think the FIIs were so overowned in the banking sector that the monies to go into the AI trade in the United States or anywhere else in the world for that matter from India came only from that sector and to some extent from the IT sector as well. Now, I'm no expert to comment on where the AI cycle is going, but I think by all measures, if you look at the commentary that's coming out of the United States, most of the commentators there seem to suggest that this is in a bubble zone now. You've seen the most recent IPO from the stable of Elon Musk that's gone below its issue price as well. So my sense is, and even if you look at a lot of the BFSI companies in the United States, they're actually cutting back on their AI spending, citing it as being too expensive. So if that trade was to reverse structurally, I think India could be a huge beneficiary of the inflows that will come in. To the point I was making in my earlier answer that this is probably not a year where you're going to see 15% earnings growth. My sense is the base effect that you'll have going into next year. And if you have some amount of geopolitical clarity after the midterm elections in the United States in November, there might be a case for a 15-16% earnings growth in FY28. I think the market participants would very eagerly, especially on the FI side as well, watch the onset of the progress of the monsoon, because you would remember when the monsoon started in June, we were 42% deficient. Of course, a lot of that has been made up. In some states, we're even in a surplus right now. But this is going to have a resultant impact on inflation, how that pans out. And I think, right from next weekend, in a sense, you get into festive season because you will have all your online platforms, starting with their Independence Day sales, and then you go into Rakhi, and then, Ganpati. And so I think you'll probably, between now and mid-November, sort of that festive period, they want to see how demand actually, sustains in India and whether there is a structural revival. My sense is post-November, you could see a very, very strong comeback into the Indian markets from the FIs. Till then, it may continue to be volatile, as you alluded to. But I think the size of the mutual fund industry as it stands today at north of 75 lakh crores is more than capable of absorbing and has been absorbing a large part of this FI setting for some time now.
Rahul, fascinating everything that you've put out. How do you see IT panning out? I mean, maybe some part of the easy gains made, but that's the eternal question, I think, with which investors are grappling with. In the medium term, can some of these companies really deliver maybe double-digit kind of returns, at least in the next 2 to 3 years?
The last time these stocks were substantially derated was when the Lehman crisis happened, and we saw them, go down to valuations of anywhere between to around 9, 10, 11 times 1 year forward P. And I never thought a time would come where we would probably, be making the case that these valuations look within striking distance ever again. Here we are, sitting 18 years out, and a lot of these companies are trading at between 13 to 15 times, staring at a further derating. Now, I think the problem with the top line IT companies is that these are very mature and saturated businesses. Now, these are not businesses that are going to grow organically in high single digits or low double digits structurally. I think the only way they can potentially do that is by doing what some of the mid-cap IT companies are doing. And that is by going out and making some bold acquisitions in capabilities where you don't have it existing currently. So, you've seen a Coforge try it and be successful. A Persistent tried it. Of course, right after it did, the stock took a bit of a knock, but, we'll wait and see how that plays out. But I think IT companies in India today need to deploy their cash balances in a more meaningful manner. I think the time for buying it for rupee depreciation or buybacks and things like that, or, plays as dividends, those things are history. I think today in a market where you have, you're spoiled for choices literally across sectors, there is no compulsion to be buying into IT. And if you look around most fact sheets of mutual funds in India, you'll find most fund managers are anywhere between 400 to 800 basis points underweight on IT at this point in time. Could there be a trade here? For sure. A good result here, a good data point from the United States, something to that effect. You get a 10-15% pop in these stocks, very, very possible. But I think, for the kind of return ratios that they have, and somewhere those are getting depressed by the huge cash balances, if they're able to put those cash balances to work and go out and buy growth, then my sense is that you could potentially see a situation where these companies go back to 18-20p, which basically means you could get a 30, 40, 50% return on these stocks. But that's not my base case. I still think if you must be invested in this sector, you're probably better off playing the mid-cap IT companies like a Coforge, KPIT, Persistent, Emphasis, those kind of names, as opposed to looking at the large cap, because they're going to outperform the growth of the large caps by at least 3 to 4x, if not more.
Wonderful to have you talking IT, Rahul. Just one more quick piece on this. What do you make of revenue deflation and the risks there? Because you seem to say that downside risk is protected, if I'm getting this right. But you believe that there could be upside potential depending on how the companies evolve. And I'm trying to get a sense as to whether the revenue linkage to man hours is a significant downside risk, which the markets, whether they're pricing in or not, what's the sense there?
No, maybe I did come across clearly. I didn't say that the downside is protected. I said there could be a good trade here. I see.
Right.
There is nothing to suggest that these companies cannot drift down to a 10 price to earnings. Now, can they correct another 15-20%? Of course they can, but that will be contingent on the fact that they have to revise their organic guidance on their current business environment lower, which you saw, say, in the case of Infosys, where they had to trim one end of their guidance by about 50 basis points. Now, the way I look at it is, how are you going to bid for orders? It's essentially, how do you get your revenues? Your revenues are a derivative of your total contract value, essentially, because I mean, in capital goods, you will have it as a function of your order book, and defense, you have it as a function of your order book. And then basically how much of that order book is taken off by the primary person who's placing the order. Of course, in capital goods and defense companies, a lot of time the government of India is the buyer, and therefore you have inventory and working capital risks. But you don't have that in the IT sector, because these are projects that are pretty much done on site, and they are done to exercise capabilities of a particular company. Now, if our large cap IT companies had that visibility, then you would not have guidances roaming around between 2 to 5%. You would see that inherently they would be, guiding for, say, 8, 10, 11, 12%, and that would revenue as well as the productivity per man hour. Now, the point is, if you get into a situation of revenue compression, it is not because these companies are not good. It is just because these skill sets and the capabilities don't exist. And that value migration is predominantly happening from A company to company B. Now, that company B could be a mid-cap IT company in India, or it could be a company somewhere in South Korea or perhaps in Indonesia. But that value migration will happen, which is why I was very clear in my earlier answer where I said that instead of having this value migration or this contract value migration happening, it's better to go out there and make an acquisition and acquire those skill sets to ensure that that compression of revenue doesn't happen. Because if you don't do that and you continue to do what you are, yes, all our large cap IT companies are reporting AI revenues, and on a very small base, they're reporting very strong numbers. But today, if I'm a JP Morgan or a Wells Fargo or something like that on Wall Street, and I want to give out a large ticket order, maybe Indian companies would not be the first phone call I make at this point. But if you do go out there and acquire the capabilities, then that changes quite dramatically. And I'm not saying that this is a 2-3 year phenomena. I mean, if you have a situation where in the next 1 quarter, a couple of these large ticket acquisitions are made, they start reflecting in revenues by the back end of this current fiscal year, you'll automatically find FY28 revenue and profit numbers being revised upwards. And then suddenly people will be saying, oh my God, we're underweight IT, and they'll move up, they'll lose the gains that will happen in that 1 quarter. So I do accept your point that that revenue, sort of compression is a threat, but it is not that revenue is vanishing, it is value migrating. And I don't think Indian IT companies are out of the race yet. Yes, prima facie, optically, as we see things today, we don't have that visibility more than, say, a 5-6% growth. But should something be done in terms of a brave call by acquiring capabilities, I don't see any reason why that cannot be integrated, and we could potentially look at a long-term re-rating of the Indian IT sector.
Okay. We'll quickly slip into a short break, but we'll be right back with more market insights. Welcome back. You're watching Market Edge, and we have on board with us Rahul Arora from Ashika Institutional Equities. Rahul, you were just highlighting to us all of the value migration story in the Indian IT space, and that's on IT. But how do you look at the consumption pack, going into the second half of the year? Seasonality is going to be coming in, and right now FMCG pack as a whole is sort of looking like sort of a contra play. You also highlighted earlier that you're quite bullish on this pack. Tell us what segment specifically are you positive on?
I think this has been one of the most underowned sectors for a very, very long time from an institutional investor standpoint. And I think, we were making the point about monsoons a little earlier. I think the fact that it has revived has given confidence. I think all of this started with the GST cuts in September last year, which has fed in and has had a lag impact. Obviously, we're coming up on nearly about a year since the GST cuts happened, but I think that has fed into the system pretty well. I think if you look at the sowing that's happening in the current crop, that's also pretty good. And that's showing up in the volume numbers for a lot of the consumer staple companies. Now, let's keep ITC aside because I think we all know that that's a heavily regulated sector and excise issues are there with respect to taxation. And we saw that in the numbers as well. And there's a reason ITC trades at the valuation that it does and had to demerge one of its more profitable businesses in the hotels business. But that notwithstanding, if you take the elephant in the room, which is something like a Hindustan Unilever, even on its base, to report a 5% volume growth was not a bad number at all. Yes, the market was somewhere between 7 to 9%, but at least it was a marked improvement from the last many years where it's been hovering between 0 to 3%. I think Colgate had a very good volume growth number as well for this quarter. Britannia, I think packaged foods is clearly the outlier. So I think if you look at Britannia, Tata Consumer and Nestle, if you're looking at consumer staples, of course, Nestle had a blowout quarter where they've grown their sales EBITDA PAT all in excess of 20%. But I think the challenge Nestle has, despite being a 100% ROE, ROC company, is the valuations which are trading at about 60, 65 times. So for an investor to buy it today, he's probably looking at an exit multiple of 80, 85, which is very difficult to give even for that kind of a company. But I think if you look at Tata Consumer and Britannia, the kind of volume growth numbers that you're seeing, Britannia reporting high single-digit numbers. Even in the case of Tata Consumer, if you looked at the salt, the beverages business, even the acquired business, the new product developments, they're all reporting very healthy volumes. So Britannia at about 43, 44 times 1 year forward, Tata Consumer at about 47, 48 times. For companies that will probably compound their profits by between 14 to 15%, I think would be clear buys for us. Beyond that, I think if you were to venture into staples, I think Marico looks like an interesting name. But we have to also see for the entire consumer staples basket how they're going to sort of navigate margin pressures if they emerge, because you are definitely seeing a situation where you did have 3 months back a huge spike in raw material prices. So we don't know how that inventory is going to play out. But my sense is looking ahead to the festive season, the initial indicators are looking very, very strong. Yes, you had an impact on, say, something like a mobile phones where, you had chip and conductor prices go up, and you saw that in Nixon's numbers. But I think consumer discretionary still continues to do all right. I think we've seen that in the hotel numbers so far. You've seen that in, say, Eternal's numbers, which is growing their quick commerce business any quarter by between 45 to 65, 70%. You've had a Swiggy analyst meet earlier this week where they're talking about 10,000 crores worth of EBITDA in 5 years. So I think the platform delivery space looks interesting. Consumer discretionary looks interesting. I think something like a United Spirits at about 1,200, 1,250 looks like an interesting name. Hotels could be interesting. Again, like I said, most of these companies have reported RevPAR growth of anywhere between 13 to 15%. And valuations, maybe Indian hotels is a bit excessive, but I think something like a Chalet Leela or an EIH look a little interesting. And if you extend consumption to autos, I think you've seen the monthly sales numbers across PVs, tractors, two-wheelers. You've seen 25 to 35% kind of growth. So I'm fairly optimistic. I think if this is a space you need to be invested in, I think for the next 6 to 8 months, you probably make more money here than you probably make in the IT sector for sure.
Rahul, thank you so much for coming in and giving us that perspective. That's, of course, on consumption. Rahul, quick 30-second answer. If you can give us a sense of how you're looking at retail and Trent in particular. The numbers were out. Do you believe that we're at the cusp of a bit of a turnaround with regard to retail and Trent in particular?
I think the numbers are pretty strong. I think not just Trent. I think even if you look at Titan with 25% kind of growth, Trent at, I think it can continue to compound at 18, 20%. And if you're talking about value retail, something like a V-Mart retail, which operates predominantly in the UP Bihar region, don't forget UP goes into elections not even 6 months from now. So I would be cautiously, a bit cautious on the valuations, but very, very bullish on the business. I think every dip could be an opportunity to buy into Trent, Titan, as well as V-Mart retail.
Okay, Titan's numbers as well. Very strong this time around. Rahul, thank you so much. Always short when we're chatting with you, but thank you so much for coming in and giving us that perspective.
Thank you for having me.
Thank you. Okay, completely timed out, in fact, on this edition of the show. Up next, an exclusive roundup of the week's key developments from Maharashtra in our Maharashtra 360 segment.
From preserving Maharashtra's cultural legacy and empowering the next generation to strengthening public healthcare, fighting drug abuse and accelerating infrastructure. Here's a look at the key developments shaping the state's progress. This is Maharashtra 360. Maharashtra has launched two major initiatives to preserve and carry forward the legacy of Lokshahir Sahitya Ratna Annabhav Sathe. Chief Minister Fadnavis laid the foundation stone for a memorial and research institute at Chiragnagar and inaugurated the renovated Lokshahir Annabhav Sathe Theatre in Baikala. The Chief Minister said the two projects will take Annabhav Sathe's literature, ideas and message of social equality to future generations. Deputy Chief Minister Eknath Shinde said the memorial will inspire marginalized communities, while the modernized theatre will create opportunities for emerging artists and expand access to culture. The Chiragnagar Memorial and Research Institute is being developed with an allocation of 300 crore rupees and a July 2029 completion target. Separately, renovated Baikala Theatre now offers an upgraded stage, improved green rooms and modern facilities for high-quality theatrical and cultural performances.
केवळ या ठिकाणी साहित्य नाही तर त्या साहित्यातनं अंगार फुलवणारे देखील लोकशाहीर अण्णाभाऊ साठे होते आणि केवळ संयुक्त महाराष्ट्र नाही तर गोवा मुक्ती संग्रामामध्ये देखील प्रचंड मोठं कार्य हे लोकशाहीर अण्णाभाऊ साठेंचं होतं आणि हे सगळं करत असताना त्यांनी जे अभिजात साहित्य तयार केलं, जगाच्या पाठीवर असे साहित्यिक फार कमी असतील की ज्यांनी दुःखही मांडलं, दैन्यही मांडलं, परिस्थिती मांडली, संघर्षही मांडला आणि तरी देखील त्यांचं साहित्य जगातल्या 27 भाषांमध्ये त्या ठिकाणी अनुवादित करण्यात आलं.
Maharashtra has unveiled a 5-point strategy designed to combine tiger conservation with community livelihoods, sustainable tourism and economic opportunities. Addressing an International Tiger Day conference in Nagpur, Chief Minister Fadnavis said scientific, conservation and habitat protection have helped increase the state's tiger population from 190 in 2014 to 444. He said technology-driven monitoring, voluntary village relocation and livelihood generation around reserves will be central to Maharashtra's effort to strengthen human-tiger coexistence. A series of employment, healthcare and citizen-centric initiatives were rolled out in Nagpur with Chief Minister Fadnavis and the Union Minister Nitin Gadkari jointly leading the programs. The Chief Minister inaugurated the Nagpur Skills Center at Pardi, announced that a decision on land for the proposed skill development university would be taken within a month, participated in the Maha Arogya Shivir, distributed appointment letters to selected candidates and launched a WhatsApp-based ticketing service for city bus commuters. Fadnavis said Maharashtra is strengthening industry-linked skill development to prepare the youth for emerging sectors, while Gadkari said the skill center and proposed university would create a strong pipeline of trained manpower for Vidarbha's expanding industrial economy. Deputy Chief Minister Eknath Shinde has directed officials to fast-track the commissioning of Thane's new 900-bed government hospital complex. Reviewing the project's progress, Shinde said the integrated civil hospital, women and children's hospital and super specialty hospital must begin serving residents of Thane and neighbouring Palghar at the earliest. The 900-bed integrated complex brings together a district civil hospital, a dedicated women and children's hospital and super specialty services. The recruitment process for 1,078 recently sanctioned posts has been directed to move forward on priority. A rooftop helipad is also planned to facilitate the rapid airlifting of patients during emergencies. The Maharashtra government is closely monitoring the flood situation in Amravati following continuous heavy rainfall in the district. Deputy Chief Minister Sunetra Pawar spoke to the district collector Ashish Yerekar over the telephone and reviewed the prevailing conditions as well as ongoing relief and rescue operations. She directed the administration to remain on high alert, rapidly assist affected residents and undertake every necessary preventive measure to protect lives and property. And that's all we could bring for you in this edition of Maharashtra 360. Until next week, take care.